back from popular demand, we got Austin Williams in a part 2 from the apples to apples comparison of a small but mighty plan. You came and did this presentation, and one of the feedback that we got was, hey, it would be really great to do an apples to apples comparison of the same age. So someone, same age, I think we're taking a 25-year-old individual. One scenario, we're giving them a fully based contract. These are the type of life insurance when someone says it's a terrible place to put your money, you'll see firsthand what a $10,000 contract does with a typical policy, and this is what lots of people sell. And then we're also going to max fund a life insurance policy, and you'll see the differences of death benefit, but you also see the differences of cash value, and it's pretty insane, Austin. It's pretty insane, the difference. And so it without really further ado, man, you're back. And I'm excited to have you put this thing together.
All right, yeah, I'm excited too. That was one of the quickest comments that we got on the last video was, hey, what would this look like if you were not comparing somebody who's different ages but the same age? And that's a fair critique, because ultimately, if you watched the last video, and if you haven't, now is the time that maybe someplace around this video, our video guy's gonna put a link to it, but that I compared two different things at once. I compared different ages and different policy designs. And so it's admittedly not a true, like only one criteria is changing. So this, I listened to you guys, and ultimately this video is looking at the same age. So we're not, because ultimately the older you get, the more expensive insurance is. So we're looking at the exact same age and different policy designs, which is kind of like more of like a true this versus that thing. So yeah, I'm really excited to get into this. It's a pretty big difference. And even at only $10,000 a year, it's still a pretty stellar difference. So we'll go onwards and talk about that. So what would a traditional case design look like for somebody in their mid-20s? Now, plenty of people in their mid-20s are, they're starting young families, maybe their spouse works part-time, or maybe they're a full-time stay-at-home parent. I know the way I refer to that with my wife is I call her a full-time household engineer, because it truly is a job that not everybody is cut out for. It's an incredibly difficult job. They bring tons of value to the house, even if it's not represented in the form of a paycheck. In a traditional case design, maybe you have about $800 a month to put towards this, right? If you're just going to, almost take like a scattershot approach and just like, if you just go to a random life insurance agency or you talk to an agent, the policy is going to be written for you is more than likely going to be a death benefit focused policy, because that's the traditional case design. Legacy is your primary concern. And there's nothing wrong with that. If that's your goal, if that's the main thing that you want to do, well then great. And then if that is the main thing you want to do though, they're going to create this product in a way for you that's going to make it really just a distribution side asset rather than an accumulation side asset. You want to add anything to that, Caleb?
Yeah, pretty much you're going to get permanent death benefit, and then they'll pitch it to you like, hey, 30 or 40 years from now, you're going to thank me. And I think you and I would both agree that, yeah, I mean, there's a lot of different examples of people that got policies like this, and over time, they look back on it and they should keep the policy. Knowing what we know, it's like, man, this could have been so much better.
So much better.
That would be like the breakdown example. And I think when people see the illustration, we'll show them, we'll kind of play both sides. I'll play devil's advocate and say like how this is a good design.
Yeah.
And how it could be sold, but then it's almost impossible to stand by that when you see other designs. Yeah. What a person in there that's 25 could essentially do.
Absolutely. Yeah. And honestly, there's a lot of agents out there that are really honest in the way that they present this, that they present it as like, kind of a legacy based product. There are some less than honest agents out there, because I just had somebody call in last week, and ultimately he got pitched a product as if it was a cash value focused product, but what he ended up actually getting sold was an all base product. So that's just kind of really not ethical behavior, and not saying that by any means, any all base policy that gets sold is an unethical product. There's lots of really good ones out there. But ultimately this happens, and these cases, they might be right for some people, but we're gonna look right now at what it actually looks like and what you're actually getting if you get a traditional case design. So here we go. As you see on the left over there, you have that base contract premium. It's a nice round number, $10,000, right? As if you watched the last video, $10,000 is about $800 a month. Okay, so you're putting in $10,000 a year starting at age 25, and you're so young, so the cost of insurance is really cheap. The nice thing is that starts out at over $1 million death benefit, day one. So I mean, that's great, right? Like, so if legacy is really the one criteria you have, and that's really don't care about anything else, then I see the value here.
Yeah, but what you could also say is a 30-year term insurance policy could be a
Could
lot
just as
cheaper. Now
easily,
the
yeah.
difference is after 30
Mm-hmm.
years you don't have death benefit.
Don't have the death benefit anymore. Yeah.
But this is where the buy term invest difference kind of takes off with
Yes.
policies like this. So a couple things, Austin, when I'm looking at this policy. So we're putting $800 a month or $10,000 a year into the policy.
Yeah.
We're showing obviously dividends are not guaranteed. We're in this company, we could use any company here, but this company we're showing dividends. So this is not guaranteed, but there's a high likelihood that these type of companies will continue to pay dividends. The cash value in year 1 and in year 2 is 0.
Zero. Yeah.
So starting in year 3, this is when you're starting to accumulate cash. But like you can see, 3 years in, you've put $30,000 in.
$30,000, and you have 1,400.
Less than $2,000 to show for it. And you have a death benefit of over $1 million, and the death benefit stays pretty similar, but it does grow, and over those 30 years, you're almost at 1.7. So in the way that I would like write this down is like 0 cash value in the first year.
Yep.
When does this break even? Meaning, when do we have more cash than what we've put in? Is it year 12?
Year 12. Yeah, year 12.
Okay. Meaning we've put $120,000 in, and we have $125,000. So after year 12, technically, you have more money than what you put in, and you have $1.1 million of death benefit. So my devil's advocate here is, over time, this policy, like if you had a policy like this and you're in year 10, 20, you should keep. I mean, it is what it is. It's like it's an efficient policy right now. But again, like would we sell someone like a policy like this if they wanted cash value? Absolutely not.
Absolutely not. No.
And that's what a lot of people are doing is they might not be doing all base, but they're like giving you a really not great design and saying like this is max funded, and most people don't know the difference, and so they just take the person's word.
Yeah, because they trust them. Yeah, and it's sad that they betray their trust in that way. And it was funny because when I first made this policy, I tried making it inefficient in regards to cash value, and Caleb actually corrected me. He's like, dude, you could actually make this even more inefficient. And it's because I added a term rider along with the base, so no paid up additions, but term rider and base. Now, the reason why it was more efficient than this, obviously it wasn't as efficient as what we're about to show you, but some carriers don't actually compensate agents for the term riders that they add onto policies. So that's another reason why agents might not add a term rider, even if it does make it more efficient in terms of death benefit, is because some carriers don't, and they only compensate based off the base. So I had to make it like wildly less efficient once I realized that, oh man, I actually made it too efficient. So I made it to
and this is another thing, and we're careful not to like. I have no problem with people getting paid for setting up insurance policies.
Yeah, absolutely.
Normally, the commission that someone can get paid is anywhere from like 50% to over 100% of the base number. Okay, so that's just think about that as we look at this next policy. That this could be someone could be getting paid 50% to 100% of $10,000 to set up this policy. It's interesting. Well, let's file that away, and then as we continue. So I think we covered everything in this policy, and I think we should go to like what could happen if that same person designed a policy differently.
Yes, I totally agree. So now looking at a small but mighty case design that's in an overfunded way. So pretty much the exact same parameters, right? That your person, they're in their mid-20s, they got young kids, their spouse works part-time, but now let's imagine instead of just, having that traditional case design in mind, they're like, you know what? I want this to be an and asset. Like I want to give my dollars multiple jobs, do multiple things at once with this. I want to have living benefits along with the death benefit. And you're like, okay. So what does that look like? So, and maybe this, this kind of this avatar of a client right here, that maybe they want a private line of credit that operates as an opportunity fund. And I think you would agree with this, Caleb, that, most of our clients, they even after we write and structure this policy for them in this way, a lot of them don't never actually borrow against it, but they love having the money there as an opportunity fund, right? That like they don't ever use it, or at least they haven't used it yet, but they love just the opportunity of being able to use it.
I think another way to say that is we're not big fans of making people or even getting people to want to use their money immediately. Like some people sell, or the whole strategy is predicated on you using your money quickly, and like we want people to build a safe foundational place to protect their family first and foremost, but to have available. And the reality is, especially people that are starting plans like this, they might be 3 or 4 years in to build that foundation, and then they can start, there's wisdom in building that foundation. So I think that's we're definitely, while you can use cash, we're definitely not encouraging our clients to use it right away, because what I've found is that sounds good in a pitch, but over time you're taking a safe asset and making it less safe. And there's wisdom in building a foundation. So yeah.
Absolutely. Absolutely. Could not agree more. As you said before in the past in other videos we've done, like you might just need to put your head down for a few years and just really kind of plug away at this. And then, you might have reached critical mass that you can really do something with it like you'd want to. The last point here is that, like, designing in case like this, kind of an overfunded approach, makes this an accumulation side asset and a distribution side asset. So let's look at the numbers of what this looks like. Same amount of money as you see over there on the left-hand side with the premium breakdown. Total premium is $10,000. Now there's also a couple more columns, because this one's not as straightforward as the other one. It's not just all base, it's term, and it's paid up additions. So you see that column on the left there, right? The base contract premium, that's buying the minimum amount of death benefit needed to keep the policy active. And we're shrinking that as much as possible. Because to make this overfunded, we're trying to make that as tiny as possible and still have the policy stay active. And then right next to it, this FPR stands for Flexible Protection Rider. That's a term rider that's built into the policy that's inflating the death benefit at minimal cost, right? So ultimately, to make this overfunded, you need that term rider on there, because you need to have enough death benefit to justify pumping all that premium in. So these two together, right, are about $1,700. That's your base. This is about a 17% base policy. And then this number right here, this is your PUAs, right? That's your paid up additions, and that's about 83%. So you have about going from 100% base policy to a 17% base policy and an 83% paid up addition policy.
And this policy is not only way more flexible, which someone could use as a disadvantage, because the more flexibility you give somebody, I think that's a positive.
Yeah.
But someone could also say, well, more flexibility to the wrong person would make them cheat themselves, which you could make that argument.
Okay. Yeah.
But instead of having zero cash value in the first year, you have over $8,365 of cash value.
It's amazing.
And you have an initial death benefit instead of what was $1 million? Instead of $1 million, you have $342,000. So I want to be really clear that the difference is you have a smaller initial death benefit. And if someone came to us and all they cared about was protection, and we thought we were doing them a favor by giving them a policy that gave them more cash value, but for the initial $342,000, that's not sufficient to protect your family. If we didn't sell some type of term insurance along with this, we could be in the wrong from a standpoint of not doing the best thing for the people. So I want to play devil's advocate from a standpoint of, like, you got to look at holistically where, like, what the goal is and how we can help somebody. But in a lot of cases, we'll either add an extra term rider in a policy like this, or we'll do another policy to supplement them on term insurance in the first 10, 15, 20 years. And you can see that, instead of having goose eggs in the first 2 years, you got pretty substantial cash value.
Cash value.
And then this breaks even in year 5.
Year 5, yeah. And the cool thing is that this is just run at a standard health rating. So, like, obviously if you're wildly healthy and you're even just pretty healthy, like, odds are it could be even better than this, because this is, like I said, this is a standard health rating. Nothing's really special about this person other than the fact that they're young. In year 5, you see 50,000. You've put in 50,000 over here. And then by here, you have just over 50,000 available to borrow against. Super cool, super liquid. Really, really help. If you have, like, in terms of wanting an opportunity fund by year 5, this is definitely the policy that's going to give you that opportunity fund versus the one we just showed, which was a lot lower, by year 5.
How much cash value was in at age 30 for the other policy?
Cash value age 30 was 614,000. Over here, it's 687. So it's about 70,000 or so
And the death benefit's pretty much
almost
the same.
Yeah, that's the crazy thing is that like, and I was going to point that out too, is that like the death benefit in this policy is almost identical over 30 years. So it starts lower, but it pretty much catches up to that all-base policy within 30 years. And your cash value is larger the entire time, right? Like it's just that's just going to be bigger, regardless. So
if I had to summarize, obviously you have a much smaller base, which would translate into, whoever sets this policy up will get paid less for setting it up.
Absolutely.
You're giving your clients more flexibility. You have earlier cash value. You have longer and better growth. And by the way, we're stopping at age 30, but if you zoom out another 20 years, it's pretty substantial, the difference, because of compounding. You have an initial way less smaller death benefit versus the other policy, but at the end of 30 years, your death benefit's pretty much the same.
Yeah.
If we're talking to someone who cares about legacy and estate planning, this type of policy is not going to move the needle for them. But for someone that says, hey, I want a policy that I can, whatever term they use, but high cash value, I want cash. This policy is going to way outperform the other policy, not just from a flexibility standpoint, but from an early and long-term cash value standpoint.
Absolutely. It's funny. You took the words right out of my mouth, Caleb, because also I have like a couple slides here. I'm like,
hey, I'm sorry. I get so excited. This is the problem with us not going through. I just go off.
It's amazing. It's because like literally you pretty much listed out all the points I have. Like, what are you giving up? Like, okay, if you go with a small but mighty kind of overfunded style policy, you are giving up a higher death benefit for the life of the policy. Like you just are. And as you saw, by year 30, it gets really close, but it is still a little bit lower. So you're giving that up. But realistically, what are you gaining? Like more contribution flexibility, more cash value for the life of the policy, and even higher dividends for the life of the policy too. So there's just a lot of really cool kind of aspects to going this route that might make sense for you. I'm not saying it does. I'm not saying that you definitely fit into this box. But if you do, and if you kind of have resonated, some of these ideas have resonated with you, such as like right here, if some of these ideas resonate to you, then maybe that this would be the right kind of policy for you. And, just call us and we would love to help you figure that out.
Yeah, we have really 2 call to actions. If you want to learn more, we have access to what we call the life insurance vault down below. You can get that for free. And if you're watching this and you're like, I would love to talk to someone like Austin or someone on the team, we have links down below that you can reach directly out to someone on our team. And we would absolutely love to serve you. And maybe you have a policy that you're not enthused about, you're not excited about, and maybe we could take a look at it. Or maybe you have a policy that you think is really great. We'll do policy reviews absolutely for free, and it brings a lot of peace of mind just at least knowing what you have.
Absolutely. Couldn't have said it better. Thanks so much, Caleb.
Yeah, Austin, you rock. Thank you for making this happen.
Absolutely. Love it.